Hi everyone, welcome to Invent Your Mind. Thank you for joining me. If you have joined my channel before, you know I'm an intellectual property and business law attorney. I'm also an entrepreneur and I used to be a scientist, so I do a lot of different things. And I don't know if you have seen this interview I did with David Ferran before, which is about a couple of weeks ago, and I asked him to come back on my channel to talk about capital markets as a way to what entrepreneurs need to know. So with that, just remember my usual disclaimer, this is for educational purposes only. This is a share of information. If you have specific questions, please go see a professional. If you're looking for legal advice, go see an attorney who practices in your state, relevant to the practice area. And if you like to connect with David, I will put his information below. And if you like to connect with me, my information is also going to be tagged below. Just so you know that David Ferran is a founder of is the founder of Torrey Project, which is a project to it's boot camps, and we talked about this in the last video. So I'm gonna tag that video onto this video so you could see it. It's about changing the mindset of entrepreneurs and the people out there and doing business for good, as using business as a way to do good things, tying that in. So I think it's a hugely important discussion. And I will tell you off the bat, I am not very familiar with the capital markets, and David was actually very nice to give me a little quick primer right before we started the taping. Other than that, from the legal side, I know things because I have done fundraising races with the public company for IP due diligence. But as far as finances and capital markets, this is actually going to be a very much a discussion, me asking questions like to ask him to explain even more. So what you could expect from this video is we're going to talk about the capital markets in terms of entrepreneurs, how we operate in the company in a socially responsible way in this new era, can bring both profits and still do good. And some of the misconceptions that have been, especially in the United States, where the inception of these misconceptions coming from, because like I said, David just actually caught one of my misconceptions, so I will point that out when we start talking. So David, thank you so much for being here, joining me. Please introduce yourself and Torrey Projects briefly, even if we're going to tag the other video, and then we could go into the capital markets for entrepreneurs.
Sure. Thank you very much, Gan. I'm really happy to be back again and to talk about one of my favorite subjects, capital and access to capital for entrepreneurs. As you mentioned, I'm the CEO and founder of Torrey Project. And at Torrey Project, we are deeply, deeply concerned about environmental degradation and social injustice. Those are really the two things that we're working on. And the way that we're going about trying to make a difference is by enrolling business as a force for good in the world. And it's really starting to catch on. Finally, we're starting to see an uptick in the acceptance of business actually having a purpose beyond just making profits for the shareholders. And so it's refreshing to see that. And we at Torrey Project are really promoting that. Business with purpose, business as a force for good, business that cares for all of the stakeholders as well as the shareholders. And as we run our boot camps and as we train entrepreneurs and as I travel around the country, at least before COVID, and talk about this subject, there's a side to it that is frequently overlooked, and that is access to capital. You can have a great entrepreneur and a great business plan, but if you don't have the capital to execute the plan, it's unlikely you're going to go anywhere. And so today, what I'd like to talk about a little bit is the challenges that entrepreneurs have classically faced in accessing capital and how that's changing in the world.
Before we jump into that, I also wanted to, because even though we did it before, I want you to share your background a bit, because it's always good to know where the advice is coming from. You have walked the walk, you have done this, so I wanted to give people who are listening your background. And I will also tag your Torrey Project and your LinkedIn information below this video, so people who are listening can take a look. But you know
All right.
why before you share the thing, I always like to establish where you're coming from and your credentials, right? Because we have a lot of people on the internet who talk about things and you're wondering what's their credentials. So
Okay. Well, in way of background, I've been a serial entrepreneur. I've started 5 companies of my own, had 3 very successful exits, one big lesson that I learned, and so I've had an opportunity to start companies. One of the companies I started, I was successful enough to grow that to become a publicly traded company on NASDAQ, and so I've had an opportunity to run that public company. I was also had an opportunity to do 2 public company turnarounds, one as CEO and one as a division president. I've had an opportunity to take 2 public companies private and restructure them. And I spent 11 years doing strategic M&A advisory work on large private equity transactions, some of which were in excess of $1 billion in transaction value. I've raised well over $100 million for companies of my own, and many times that for companies of other companies that I was advising. So I've spent 42 years as a business operator and entrepreneur. I raised my first $1 million in venture capital when I was 23 years old. So I've been rolling around in this pond of capital markets for a long time, and I got the bruises and scars to show for it.
well, here's why I'm so excited that you're willing to do this, because I think anybody who's starting a company or in the startup space, it's really important to know what these are and understand how, because we are making long-term plans too, not just your like what is it now, but what you're going to do with your company in next 5 years, next 10 years, or whatever you want to do. It's good to understand capital markets, availability to capital, and even how you talk to your investors about this going to matter, how you pitch. So I hope this information going to be helpful. So with that, David, let's start talking about shareholder primacy that you mentioned, and in the how it started in 1970s. I like the history lesson you shared with me.
Sure. Well, as background, I mentioned 1978, I started my first company and went out and I raised $1 million in venture capital right up on Sand Hill Road in San Francisco, at the heart of venture capital at the time. And I learned about business from my venture capital investors. I also had a venture capital investor from Manhattan. So I had the good Wall Street perspective. I have the California Silicon Valley perspective, both sitting on my board and both teaching me, the young 23-year-old, what my job was as CEO and how I was supposed to run the company. And they made it very clear to me that I, as an officer and director of the company, had a fiduciary duty to maximize the return to my shareholders. And I believed them. And this was based off of an op-ed that was written by the world famous Nobel Prize winning economist Milton Friedman. And in his 1970s New York Times op-ed, he took the position that business had one purpose and one purpose only, and it was to maximize the return to its shareholders. And that became known as shareholder primacy. And Wall Street loved it. The investment community loved it. Think about that. You mean what we're going to do is we're going to say the only body at the table that matters, the only person at the table that matters is the shareholder. none of the other stakeholders. So we don't care about our employees, our customers, our business partners, our service providers, the communities we do business in, the environment or society. That's easy. We don't have to care about any of them. All we got to do is make decisions that maximize profits. Very simple.
No, I have heard that too. You know, in law school, and I don't remember where I picked it up, so I'm not gonna like blame some class or something. But the idea is that you have to what matter for a public company is the return to the shareholder profits, and the decisions by the management had to focus on the profits, making profits and the revenue and return for the shareholders. So that's always the key. And even the business judgment rule that you hear about, that management, the board had to be aware of, the C-suite, you know, the CEOs, the president, and the you know, CFOs, all these, they had to think the business judgment rule that protect their decisions is based on making profit for the shareholders. Is the idea that then they are within that, while if it, you know, if it's more losing profits with and caring about maybe something, a bigger goal is a issue. So and we could talk about that later, but I just wanted to put that in context, what you're saying, really how that is came about, and where this misnomer got added on like a huge snowball, right?
Absolutely. And that's exactly what happened is people came to believe that there was a legal obligation of officers and directors to maximize return to the shareholders in the short term. And when I say in the short term, that's the key thing here, right? Wall Street measures your performance in 90-day increments. And that's frankly all they care about. And I can tell you, as a former public company CEO and former public company chairman, we were absolutely beholden to the analysts on Wall Street. I had to tell them every quarter what we were going to do. And then at the end of the quarter, I had to tell them what we did do. And in between, it was a 90-day scramble to make it happen. And so all of the focus is on short term. And I think one of the things I really want to emphasize is that there's, first of all, not only is there nothing wrong with making profits, and there's nothing wrong with creating tremendous value for your shareholders. In fact, that's an obligation. If you're going to lead a company, you're going to be CEO, you ought to be absolutely committed to creating value for your shareholders. And if you aren't, you don't deserve to get capital. The question is, are you doing it with an exclusive focus on creating profit? And are you doing it with a short-term mindset in a win-lose way? Or are you saying, I am committed to creating tremendous value for my shareholders over the longer term? And while I'm doing that, I am committed to there being a win for every one of my other stakeholders. That's the difference. That's what we're trying to do is at Torrey Project, is get the message out that you can have it all. You can do great for your shareholders, and you can reward them for giving you the capital that you desperately need to build your business. They deserve a reward, but it doesn't have to come at the expense of your other stakeholders. They can all win together.
I think that's the key. It's this whole idea that it's had to be mutually exclusive to one or another. Is actually an idea that I'm really into mindset, setting your mindset for abundance. And it's the idea that you could only do it this way, right? But like what you are saying, and what Torrey Project stands for, is that idea is that everybody can win. And you could win big if you actually bring it together. And I'm a true believer in that, because I think it's really frustrating to me when people are talking about certain things that could long-term actually be very costly for companies. And when you look at, if you put in the proper protection and function in a better, more sturdier way. Even though maybe in the 90-day increment, like you said, maybe the profits wouldn't be as high, but it's like you could build on it, and you're actually building that. It's like, expecting some instantaneous feedback, that is not the best way to go about, right? So
and it's just taking a broader look. One of the people that I really respect and has taught me so much is Ed Freeman at University of Virginia's Darden School of Business. He's one of the early thought leaders on what's called stakeholder theory. Stakeholder theory says that the duty of management and officers of a company is to fairly balance the return to all the stakeholders over the longer term. And that's really the approach that we favor at Torrey Project. I believe that's the way we're going to heal the planet. I believe that's the way we're going to heal our society. And the issue is that today, if you want to do business that way, you better not be thinking you're going to do business on the NASDAQ or the New York Stock Exchange, because that kind of behavior is not tolerated by Wall Street. There's a solution coming that we'll talk about a little bit later called the LongTermStockExchange. They've got an answer, and they've got a solution. They've got a lot of people getting in their way, but I believe that they're going to be successful, and that they're going to be part of how the world changes. And clearly that's going to have impact on the capital markets and some of the things we're going to talk about.
So with that, I think, like I said, I'm really learning from you. So I basically ask you to kind of drive the topic, what you want to discuss to this topic, just because I think I have a very superficial knowledge, and I don't have the depth to kind of direct the conversation. So
That's okay. So Gyani, if you're starting a company, and now the kind of, when we talk about capital markets in the context of today's discussion, I'm talking about the capital markets as they apply to a company that has the potential to grow and scale to the point where it could be a publicly traded company. And now that's a very small percentage of the total companies that are founded each year, right? We've got somewhere around 30 million small businesses in the United States. And of the companies in the United States, there's only about 6,500 with market caps over $1 billion, right? So it's a small percentage of the overall, but I just want to be clear that we're talking about capital markets for companies that have the potential to grow and scale. And because it's a very different way that you fund companies. If you're a mom and pop and you're opening a small store on a street corner, your need for capital is going to be very different than if you're starting a company to design and build semiconductors, right? And it's very different in terms of the amount of capital you'll need, the type of capital you'd need, where you would get that capital. So they're two very different discussions, and I'd be happy sometime to talk about capital for small business entrepreneurs, but this is for entrepreneurs looking to build a business of scale. And
go ahead. Go ahead. No, go ahead.
I was just going to say, if for those entrepreneurs, the way that it typically works out is you start out with what people call friends and family money. I sometimes refer to it as friends and family and fools, because only a fool would give you money if they're not friends and family at that stage, because it's the riskiest time. And that's where all of us entrepreneurs start. My first company, the one that I ended up taking public and being so successful with, started with my dad borrowing $8,000 from my mother's sister. And that's how it started. And that's the way most companies start. After that, we didn't have angel investors back in the early days, but angel investors have emerged, and they've become more sophisticated, and they're easier to find now, and they have more money under management. So very often, an entrepreneur that's looking at a business that has the potential to really grow and scale is going to go from their friends and family money to angels. And the angels have a tendency to want to come in before venture capital. So they're that bridge between friends and family and venture capital. Back in the 70s, venture capital was quite comfortable getting in very early stage on a company, very early stage. And they've really, for the most part, backed off, and they're letting the angels take that now. And of course, there's some VC funds out there focusing on the very early stage companies, but the vast majority of them are now a little bit later stage. And so after, if you've been successful in deploying the capital that you got from the angels, then you have an opportunity to look to the next tier of capital, and that's venture capital. And so you've got to go out and you've got to get your venture capital. And assuming that you take your venture capital and you do all the right things and you don't get fired. And by the way, founding CEOs, 70% of them get fired within 2 years of taking their first round of venture capital money. 70% don't make it for 2 years. But if you're one of those 30%, and I was lucky enough to squeak through, you get to move to the next level of capital, and you can either immediately go public, or what is more likely is you're going to bring in some private equity, and you're going to do some further growth and expansion, typically through maybe acquisitive growth, and you're going to build your revenues and you're going to build your company using private equity, getting up to that bar where you can access the capital, the public markets. And then the big badge of honor for all of us entrepreneurs is being able to graduate to the big leagues and take your company public. And that's really where you ring the bell and you know you've made it. And so that's it. It's friends and family to venture capital, to angel, to venture, to private equity, to IPO is the way it typically works.
So with that, David, I hear that sometimes people say, the reason we're having also this discussion is we have been talking about like benefit corporations. And, we see our very venture capitalists are very uncomfortable with that, because like, I think you mentioned this, that you cannot list like benefit corporations probably don't have a entrance. It's NASDAQ or New York Stock Exchange, right? So having these discussions is important, because it's important to change that mindset, right? Going back to our initial discussion about how the shareholder primacy versus a stakeholder theory, and having a more balanced outlook for businesses. So can you kind of discuss that, like how like the benefit corporations kind of changing things, but the challenge they're facing with these capital?
Sure. And for those that weren't there for our last conversation, just very briefly, most big companies in the United States, and I believe almost all public companies in the United States, are C corporations. And the people at B Labs have done an amazing amount of work, and they created something called a benefit corporation, and they've had to go state by state by state to get that legislation approved. And 35 states have now approved benefit corps. And a benefit corp is essentially the same thing as a C corp, except it very specifically mandates that the fiduciary duties of the officers and directors of that corporation shall be to balance the return to all stakeholders. So the great thing about a benefit corp is, if I'm CEO of a benefit corp and I reach out to raise capital, they know I'm a benefit corp, and they know that I'm operating with a focus on all of my stakeholders. I have fully drank the stakeholder theory Kool-Aid, and that's the way I'm going to run the business. They give me money knowing that I'm a benefit corp, and then I act accordingly.
And it's about transparency too, right? Like, it's about that putting it out there, this company, it's going to be for the benefit of like changing climate change. Like, if something you're working on a product out there, right? Putting it out there, or like even pharmaceutical companies, I could see them going, like cancer therapeutic company that is forming could be a benefit corp. But
Yeah. All
we are back.
companies could be a benefit corp. Because there's no business that I can think of that wouldn't work well as a benefit corp. All you're saying is that we're all going to win together. We're going to run this company with concern for all of our stakeholders. That's all it is. But back now, when we get to the public side, right? Wall Street, as you correctly mentioned, the NASDAQ and the New York Stock Exchange is not really friendly towards benefit corps. And a benefit corp that's really walking the talk of being a benefit corp will typically go out and get certified by B Labs so that they become a certified B Corp, which to me is the best of the best. A benefit corp that's gone through the B Lab certification. Not only are they saying that they're committed to serving all their stakeholders, but they've gone out and they've gotten audited and re-audited on a regular basis to prove that what they're actually doing in practice matches the theory. That's wonderful. So how many companies and I'm talking parent companies, not subsidiaries, how many companies that are directly listed on NASDAQ and the New York Stock Exchange are certified B Corps? I think
I
there
don't think
might be one. There might be one.
it's Pentagonia, one of them. I
No,
know. No.
no, they're a certified B Corp, but they're not publicly traded. I think there's an
Okay.
education company from South America that actually did it, and I won't get into some of those dynamics, but they had a little unfair competitive advantage on that front. But that's okay. But the point being that of all the companies out there, we're struggling to think: is there one? Might there be two? The truth is that NASDAQ and New York Stock Exchange don't want benefit corps. They don't want B Corps. And they're pushing back. And if you take a look at the story of Etsy, Etsy was a benefit corp. I'm sorry, they were a certified B Corp and they were publicly traded. And as a certified B Corp, they only had 2 years to convert to benefit corp status or they would lose their B Corp certification. And the CEO, Chad Dickerson, was committed to converting to benefit corp status so that they could keep their B certification, their B Lab certification. Wall Street pushed back. The board got nervous and said, no, we're going to have to give up our B Lab certification. We don't want to upset the investors. And the net result was, Chad said, no, we got to stick with this. We're doing good things. Etsy's doing good for the world. It's doing good for its shareholders. Let's stay the course. They fired him. And so it's hazardous to be a public company CEO and even talk about these things, let alone do them. And so that's the challenge. If the public markets aren't available to this kind of company, then the people that typically invest in new businesses before they go public don't want you to use those structures because they see it as a barrier to going public, which is why the long-term stock exchange is so important. There's a new stock exchange. They're going to start trading. They were approved in 2019. They'll start trading later in 2020, at the latest early 2021. And it's a stock exchange for companies that are committed to serving all their stakeholders. And they're committed to making money for their public shareholder investors, but doing it with an eye towards bringing everybody else along and having everyone win together. So they're committed to profitability and shareholder return, but just with a longer term point of view.
I think that's the key, right? Sometimes if you don't have the availability, you cannot go through the roads that are already there, then you create a new road. So, and that's why we are having these discussions, because there's a new generation of entrepreneurs out there, new generation of investors out there, and then there's people like you who have been in that space but realize the harm that this traditional thinking had caused. You admitted to that in the last last video, so I'm not like anybody who's watching this, they're like, whoa. Like David actually said, he's why he's in this space, because he have grandchildren and he want to do something good for the world and create, both sides bring balance. So with that, let's talk about the long-term stock exchange, what it is, and what the viewers out there can do to participate.
Sure. Well, there's opportunities for everybody with the long-term stock exchange. For entrepreneurs looking to start a new company and grow a company that has the potential to scale, you need to know that the long-term stock exchange is going to be a viable way to take your company public here in the United States. And you don't have to sacrifice your values. You don't have to sacrifice your purpose in order to become publicly traded in America anymore. And so I want the entrepreneurs to know there's a way that you can do it, because up until now, without having that, there wasn't a viable path for American entrepreneurs to grow their company, maintain a commitment to all stakeholders, and believably go public. Now that exists. And now they can hold dear when they go out and talk to angel investors. They can say, we're a benefit corp and we intend to stay a benefit corp. We're not going to have to convert to a C corp in order to get public. We're not going to have to give up our values to go public. And they can go to the angel investors and they can maintain their integrity. And when they're ready to go to venture, there is a small portion of venture capital that is being set aside for these kind of companies. In the long term, I hope to see to it that a lot more venture money is being earmarked for socially responsible companies, companies that are based on stakeholder theory, where they care about all of their stakeholders. We need more and more of the venture capital looking for those kind of entrepreneurs. We need to reward those entrepreneurs so that as new people are thinking about starting businesses, that's the first thing they think of is, hey, I'm going to start a benefit corp and I'm going to take care of all of my stakeholders, and I know that capital will be available to me. If I've got a good business plan and if I've got a good team and a good value proposition, there is capital for me. Today, the entrepreneurs that go through the program at Torrey Project, I would say almost all of them would love to get capital from those sort of sources, and almost all of them believe it isn't available. They've been led to believe that, oh, if I talk about benefit corp, if I talk about purpose, if I talk about stakeholders, if I talk about values, I'm just not going to get funded. And for the most part, historically, they would have been right. So that's the key, is having the long-term stock exchange as a place to go to gives you the ability to maintain it when you're talking to your friends and family, your angel investors, your venture investors. And I don't know, private equity is a real tough nut to crack. I don't know about that one.
Well, I think, I really like have hope, because I feel like there is a shift in the paradigm shift of that social enterprise, social causes, that we live in a one ecosystem, that we cannot pollute our ocean and pollute our waterways or the air and make money. That's money is not going to be worth anything if you're dying from cancer because
Right.
of those pollution, right? Like, so I did cancer research, I did diabetes research, and I could tell you that these things that are happening with the companies, that what's in our ecosystem, what we eat, how we what we breathe, what we take in, all of that adds up. And that's why you see some of these illnesses, right? So if you look around, and I just had to say this because, I just saw that Ruth Bader Ginsburg, who's one of my, like she's such an inspiration. Her cancer have returned, and there's several other, like civil rights leaders who passed away. John Lewis, who was fought a cancer. So I feel like, cancer, we hear that term a lot, and there's, a lot of studies that, different causes of cancer and all of that, but you have to know that the the ecosystem we are living in, what we're putting in our body, that's coming from corporations that are putting stuff out, and how they treat the environment does impact us. We don't live in a system that is isolated. We live in an ecosystem that is connected. And that's, I think, if anything, COVID-19 have shown us that how connected we are as a community, how we had to work together, right? So I think this concept of using business for good, and using business to actually solve problems instead of create problems, because businesses do solve problems, but what if the businesses who solve problems can also rely on, like what you said about, like what happened with ITSE, right? They don't fire the person who is like trying to do good with that business,
Exactly.
So I think that's the key, and I love having these kind of discussions. So I wanted to give you a chance to add anything more you want to add to this, because we are trying to, I want to honor your time and
I
honor,
understand.
you know.
Well, one thing, I mentioned that everybody can win with the long-term stock exchange. So I just want to explain what it is very briefly, and then what the opportunity is. So very briefly, the long-term stock exchange is just like NASDAQ and the New York Stock Exchange. It's a place where companies can go public, and where people and institutions can buy stock in those companies. It has a different set of rules, and that different set of rules rewards management and requires that management use a longer term approach. So one of the things they've done is they've eliminated any sort of compensation for officers or directors that's tied to a metric that has a measurement period of less than 1 year. So now monthly goals are gone and quarterly goals are gone. And those are really big deals in terms of the bad behavior of large corporations is very often associated with these short, typically quarterly goals. And so the long-term stock exchange is addressing the way management operates. It's also an opportunity, though, for everybody who wants to buy stock in publicly traded companies to, rather than buying stock in companies traded on NASDAQ and New York Stock Exchange that are using the old model and perhaps hurting society, perhaps hurting the planet, you can take your same money and invest it in companies that are traded on the long-term stock exchange and be making a good return. I believe that you're going to get a better return with those companies, particularly over the longer term, while at the same time promoting positive social change. So as an individual, we can all help out by buying stock in those companies. Also, public companies, the vast majority that gets invested in public companies comes from institutional investors. Those institutions have billions and sometimes trillions of dollars. And where did that money come from? It's typically the pensions and retirement funds and your 401ks. It's our money. And we give it to these big institutions to get a return. We can start requiring that those institutions put their money in companies in the long-term stock exchange. And there's some precedent. There's an organization over in London called PRI. It's the Principles of Responsible Investing. And so the PRI Academy over in London is actually a global initiative. They are affiliated with the United Nations, and they are advocating to all of the fund managers around the world to sign on to an initiative where they're going to take at least some of their capital and they're going to invest it in socially responsible companies. And they're having real success. It's a movement that's growing. And then you've got series on the United States East Coast, and they're advocating for companies, fund managers to invest in companies that are doing good for the planet and the environment. And they're having an impact. So there are organizations out there that are starting to drive investment capital towards companies that are doing good at big scale. And that's really exciting for us. And that's the opportunity. So if you're an entrepreneur, you want to be really successful and take your company public on the long-term stock exchange. If you're an individual investor, find a company on the long-term stock exchange you like, they'll be there next year, and invest in it. And if your money's going into a retirement fund, try to drive that towards long-term socially responsible investment. And that's my story.
I love it. I love it. Thank you so much for sharing this information. I am so grateful for people like you who have the experience, who have been there, done that, to actually be speaking out to others, because I think we need the knowledge. Knowledge help to drive smart business solutions and smart business decisions. And I think also as public, as anybody who's watching this, you could also make these conscious decisions. So I think, like I said, we live in a one ecosystem, this Mother Earth. So I'm a huge, believer in like doing something good and taking individual responsibility, and also asking others to take their responsibility. So with that, thank you for joining us. If you like this video, please like, share, subscribe. Subscribing does help because it gets the videos out to others. So if you like to connect with Torrey Project, connect with David, I will put that information below. We did talk a bit about the benefit corporations and B Labs. If you're curious about that, I do have a shorter video on my channel about B Labs and what the differences are. So take a look at that. And thank you. And until next time, thanks for joining. Bye.
Thank